Hello, hello. Good morning, good afternoon. Okay, guys, just give a minute and we'll get started. Is audio okay? I just moved my microphone a little bit far away from me. So just want to confirm that audio is still okay.
Fine.
Okay, thanks, Sri. Audio is good. Thank you, Jay. Okay, so let's. All right, so let's get going. Good morning, good afternoon to you all. Today is our 191st session. It's been almost 3.5 years. It's fun to come every Saturday morning and spend some time with you all. Hopefully, I hope that I'm able to continue it for long enough, as long as my abilities allow me. And thank you guys for joining in. So today, I think two main topics. One is want to talk about investment process. I'm a part of a community, and then a lot of folks just asking, okay, how do you get started in investment? So I thought, hey, I've been talking about these things in this Saturday meetup. So maybe join in and we can discuss about that, right? Other thing I also want to do is we have a new stock which is coming up for IPO. The stock is Birkenstock, and want to do a pre-IPO review. So I think the last one that we did was Instacart, and now, yeah, IPO market hasn't been that hot, but that's okay. We had 3 IPOs. All of them turned out to be not that great, after a couple of months. But so, I mean, it is what it is. So there's a new one coming out, is a Birkenstock. I do want to spend some time on reviewing that and give you my perspective or feedback on financials, etc., of the company and background and all that stuff. And of course, we'll start with a little bit of macro on what happened last week. Not that a week makes a difference, but it's good from an engagement perspective. So these are, I think, the topic that I have, and I know I recognize a couple of names that pinged me yesterday, and I think are joining here for the first time. So if you don't mind, if you can introduce yourself and just let us know, what brings you here. Let's start with Sushil. So Sushil, I believe this is your first time here, right? Yeah. So what brings you here and what are you interested in? Okay, that's fine. So let's move over to Kavita.
Hi Vivek. Hi, hello everyone. So yeah, this is my first time here. I have been investing in stocks from March or April of this year. Before that, my husband used to take care of the stocks investment. But once I started reading, researching, and then I have changed some of the things in our portfolio. And I still want to learn more. And I saw Vivek's message that he has been doing sessions. So I thought it's since I'm already into it and I want to learn more, probably this will guide me further.
Cool. Welcome. Yeah, it's never too late to start in investing. Everyone starts with their own journey, and welcome you here. And again, I think we all are learning here. For me, it's a lifelong learning journey, because markets are so dynamic that there is every day there's something new to learn about the markets. So thank you for joining, Sushil.
Yeah. Hello, Vivek. Yeah, it is good to join this group. So I am doing like individually myself on some stocks or some pre-IPO investment. But like yesterday, I saw your message and I thought it is good to learn from the experts. So that is the main reason to join this call. Yeah.
Okay, cool. Welcome. Yeah, we, like I said, I think most of the folks out here, and we'll have some more folks joining in, are retail investors. Either some of them, I think, or maybe a couple, are full-time traders. Otherwise, most of them are just like retail investors, invest on the sidelines, and that's what I focus on. So if someone is looking to do a day trading, this is not a group to join, because that's not what I focus on. Yep. All right, I see another new name, Abhi. Abhi, is this the first time you're joining here?
No, yeah, this is Abhishek here.
Oh, Abhishek. Okay. You are an old timer.
Yes.
Okay. All right. You're coming back. Okay. All right. So let's yeah, Abhi has been a long time. You are one of those earlier OGs and kind of a little bit then disappeared and now coming back. So boomerang, welcome back, Abhi. So let me go through some comments. Sam, you're saying bought 50 shares of CRSP, I believe is a CRISPR Technologies at 40, and 200 shares of BAF, which probably trade in not in unit. It's on a pink sheets for 10.4. Yeah, I have no comment on. I mean, Baba, we have talked about multiple times, so don't have to repeat it. But CRSP, I believe, is that a CRISPR Technologies, right? Yeah, CRISPR Therapeutics. I mean, yeah. So that's more on a gene editing, etc. The future of this is very promising, but I don't know which companies will succeed in it, right? So it's a biotech, risky, but if it suits your profile, go ahead with it. I know Kathy Wood is pretty bullish on this particular sector, which is all around genomics and gene editing. CRISPR is one. There are other similar stocks in the same space. Not a space that I follow very closely, so won't have much comments on it. But one thing I know, I think it was earlier this year where we actually saw the real use case of gene editing, which was around a girl that was suffering from in UK was suffering from a terminal cancer and was given this unproven gene editing treatment, and she recovered in 6 months and had no relapse. So that was a big news in this industry. And during that time, I also thought maybe all the stocks related to gene editing, would fly. But again, that was just one use case. The technology has to still commercialize it. But that's my thought on it. But if you have a really long-term scenario and willing to wait, good for you. See, if I had bought 10 shares of Tesla at 2011, yeah, I mean, everyone have those buyer's remorse. If I had done that or not. Let me put it other way. Sam, maybe if you had bought 10 shares of Tesla in 2011, you probably might have sold it out, in 2013, 14, 15, when it would become double, right? So that's another thing to look at. Okay, all right. So let's get going with today's session. And as always, if you have any questions, feel free to either raise your hands if you want to talk about it, and then you can unmute yourself and post your question or put it in the chat. I do monitor the chat, but if I miss your question, feel free to ping me. Okay, so let's look at about the recent happenings. Guys, Friday, we had a very green Friday, and it was, I don't know if when did you watch the market or not, but I was listening to the news in the morning because there was a jobs report that was about to come out in morning, right? So when the job report came out stronger than anticipated and markets just crashed, I would say the futures crashed, and then markets opened lower, and then suddenly it was, I wouldn't say suddenly, but in a very short period of time, it was suddenly, it was completely opposite direction, and the markets just zoomed up. So after 3-4 weeks, I hope all of you are entertained, your portfolio is entertained, and you're happy about what happened on Friday. But like I always say, one day doesn't make a difference, or 1 week or a month doesn't make a difference. We have to stay invested for years. But this is how the Friday looked like. I mean, almost every sector was green, except some reds I see is in energy, which is ExxonMobil and think Chevron. I know why Exxon was down because of acquisition news. Microsoft, Nvidia, they're all up like 2% and whatever. I mean, it was a green. So we haven't reviewed this chart, but we finished Q3, and this is the first meeting after Q3, and I found this interesting chart, which actually gives you a bird's eye view of what has happened across different asset classes. Not in the US, but also outside of the US, right? So if you look at the major market ETFs, SPY is up 13%, was up 13% by end of Q3. And even now, if I look at where did SPY end up? SPY is up, it's close to 13%, right? So SPY is close to 13%, QQQ ended Q3 at around 35% up, which is what tech focused, and no surprises. Look at Nvidia is up 200%, Facebook is up more than 100%, Google is up from 60%, Apple is up from 40 to 50%. So given the fact all these tech companies are up so much this year, not surprised to see that the NASDAQ 100 ETF is up 35%. Okay. What else caught my eye? Looking at, these are sector specific. Some utilities, which is generally considered as stable, have been clobbered this year, is down 14.43%. And the other fact is around your bonds, right? If you're a new investor, or generally you'll hear stocks are risky, bonds are less risky, right? Bonds are not risky, stocks are risky. Look at this year so far in Q3, at the end of the Q3, bonds haven't performed. 7 to 10 year treasuries is down 3%. 20 plus years, which is a long duration bonds, is down actually 10%. So the traditional wisdom of bonds are less risky, stocks are more risky, hasn't played out. And again, I mean, and we know all the reasons why this has happened. It is because of the increase in the interest rates and the increase in the Fed rates, right? The short-term rates increase, and that's caused this. But imagine if you were approaching a retirement and you followed the whole concept of bonds are less risky, and been holding bonds, majority of your investment is in bonds. This year it's been tough, right? Not only this year, if you recall, 2022 was, I think, the first year, probably, if I'm not wrong, maybe in history or maybe in 50, 60 years, that we had both stocks and bonds go down. So all the theories around portfolio management, right? 60-40, or you should increase your bond allocation as you move towards retirement. All bets were off. All theories were like thrown out of a window last year. Equities were down 18%. I think bonds were, I don't remember the number now. We looked at that performance at the start of the 2023. Bonds were down. So there was no respite unless you know really how to hedge your portfolio. And that's what I guess we'll be learning here and doing it. Looking at global markets, surprisingly, Mexico, our southern neighbor, did much better, almost 19%. I mean, ignore the, I know, yes, it was yesterday, day before, there was some news around Mexico on some airport stuff, because a lot of investors got attracted to investing in Mexican airports. And then, someone will highlight and look at the risk. But so far, of course, the US is around 13%. Italy outperformed. Mexico was almost 19%. Spain is 15%, right? Emerging markets so far haven't performed. And one reason why the emerging markets, EEM, which is emerging market ETF, hasn't performed is because of China. So China hasn't done well this year. The biggest allocation in the emerging market EEM ETF comes from China, so that hasn't done well, and it has dragged down the performance of the whole ETF. India has done well. I think India is around 10%, not as good as US this year, but I think over the last 10 years, India has outperformed the US. Looking at commodities, natural gas, down 51%. We won't imagine, you won't think that this could happen when a lot of, the embargo is being placed on Russia, because Russia is one big producer of natural gas. And natural gas has its days right after the Ukraine invasion. But since then, haven't seen much performance, right? Oil has been going higher, but I think over this week, oil also retraced back. But I guess looking at 2022, it was the energy sector that did great. And so far, it's still doing okay. Bonds we already looked at. Anything that catches your attention here? I thought maybe at the end of a Q3, it's good to look at, how various sectors / areas did. Okay, I'll look at a couple of comments. Ramesh said, took a wild ride. It was fun to see up and down. Oh, exactly. And those who were looking at the futures, Ramesh, and probably would have short the market at the opening. And if they had held it, they all got butchered on Friday. I mean, I was surprised because early morning, I think 5:30 when I got up, I looked at it. Oh, futures are down because the jobs report is so strong. Oh, that's fine. And then around 10 o'clock, when I went back, and I was like, oh, the things are completely reversed. Markets are all green. Jay asking, any free websites to detect sector rotation? Not that I'm aware of. I don't know if anyone else is aware of. Shripi says gold. Where is gold? GLE. Yeah, gold hasn't performed. Okay. So this is, and as you guys know, I do hold gold in my portfolio. I shared portfolio at the end of September, and it's still in top 15% of my overall portfolio allocation. But gold didn't perform last year, didn't perform this year. I don't know when the gold will perform. It's considered to be a safe haven. If there is an uncertainty in the stock market, what's bigger uncertainty could there be, where we're looking at recession, where we had a Ukraine invasion, where we have China and US and Russia, all three looking at the same Cold War situation. If that's not risk in the overall market, I don't know what it is. Gold is considered to be an inflation hedge. Didn't see that working out even last year, right? I don't know. Gold surprises me. I've heard theories around that its prices are being manipulated, right? I mean, I'll hold it. It's just from a diversification perspective. I do want to hold kind of gold and silver in my portfolio, and will continue to reduce the cost basis. I'm not adding any more gold to my portfolio. I mean, maybe a little bit of if I find it oversold for a short duration, I might sell a put spread, take a little bullish position. But overall, I'm just holding what I have and just reduce the cost basis of, and wait for it to do what it is supposed to do. I don't know, Shri, what's your thought on gold? But I haven't seen gold performing in the situations where it is supposed to. All right, weekly performance, not too shabby. I think we had a bad, more red days during the start of the week, and now probably have gotten back. Other thing I want to talk about is, and this is what I've been, I think, hampering it multiple times, is there's no one knows anything. Any predictions, whether it's me or you hear anyone on a YouTube or on Twitter or whatever social media you follow, or even if you read on traditional newspaper or on CNBCs, right? This week proved again that even PhDs have no idea. Economists have no idea what's going to happen, right? So employers added, the jobs report came out, employers added close to 360K jobs. That was almost double of what the average of economists' predictions was. I mean, if it was a for-profit organization, and if your estimates are way off, like almost 100%, you get fired. If I've estimated I'm going to make, $1 million worth of sales, and I am down, like I'm only made 50, I'll get fired. So, or if I say my cost or expenses will be 10 million for this year, and eventually turns out to be 20 million, the CFO is not gonna, stay for longer. But I guess economists have, they can get away with whatever predictions, So it was really surprised that the numbers were off by almost 100%, right? So I'll repeat what I read in what Howard Marks it's not Howard Marks. I think I read in his book, but someone else has said there are only two types of forecasters. One, those who know that they are wrong. Number two, the second type is that who don't know yet that they are wrong. These are the only two types of forecasters. So any forecasting, any predictions, please take it with a pinch of salt. I don't think we have an idea what market's gonna do in short term. Gold and silver stock ticker, is it PHYS for gold? Also, Jay, thank you for answering. Yeah, so silver, there are a few more. I think silver GLD is for gold, which is the biggest gold ETF. The other way to look at gold is some people, instead of investing directly into the paper form of gold, if you want to take exposure to gold mining stocks, then you have got these ETF, GDX and GDXJ, which is gold miner juniors. Silver, you got SLV, you have SILV also is another ETF for silver. And then, of course, you got a futures, GC and SL. All right. Okay. So what's happening in the market? And this is my thought on. Again, could be wrong. I'm not even an economist, or I'm not even a financial person. So I could be 100% wrong. But I got to say what I feel about it. What's driving the market is the 10-year bond yield.
Vivek,
Go ahead.
are economists right? They look backwards. They don't look forward. I had a guy on Seeking Alpha. He's was a economist to be. He said we can't predict the stock market or the economy. We just look at what happened, like a historian.
Yeah, I mean, that's what I'm saying. But people will, and the economists, they will still throw out their predictions. They'll come on to CNBCs and talk about what's gonna happen. But and guys, that's what I always say. Everyone, your guess is as good as anyone else's.
Excuse me. The guy said, aspiring economist said, we know what happened, not what will happen.
Oh yeah.
So your guess is as good as theirs.
Yeah, what has happened? I mean, that's there in the books. So I don't need to know what has happened. Please tell me what is gonna happen. Okay, so at least what I saw in market is it's okay. Let me just close down the window. Someone is doing some work right outside. Okay, that irritating noise is gone now. Okay, so 10-year bonds is driving the market. I'm not surprised because, you know, if 10-year yields are going higher, why would you take a risk to invest in the stock market when you can get what 4.8% in 10-year treasuries, which is risk-free? And market has been very sensitive to these movements. Other thing which is driving in the markets is what's the expectation around Fed rate hikes, right? Like it or not, but over the last, since I would say 2008, last 15 years, market has got addicted to Fed stimulus, right? Free money. And ever since Fed started to increase the interest rates, we are seeing turmoil in the markets. And now we're waiting on when is Fed gonna stop the rate hikes? More importantly, probably when it's gonna cut the rate hike, cut the rates. So if economy is too hot, and that's the initial reaction was when the jobs number came out, that, oh, wow, employers added so many jobs, economy is still running firing on all cylinders, still too hot. That means inflation will continue to stay high. It means Feds will continue to increase the rates longer than what we expected, or probably will, not cut the rates in July I think is a recent expectation. May not cut the rates in June or July, but probably will. These high rates will stay for longer, and that's where markets drop down. Third thing, which probably is a recession probability, if because of the Fed funds rate, companies start to cut down on any investments because now it's expensive to raise money. If economy becomes too cold, if you slip into recession, that will start to show up in the earnings of the companies, right? And in the long term, stock market is nothing but reflective of, the future cash flows discounted to the present value. So if the earnings are going to be crushed, that doesn't bode well for the stock market. Okay. Fourth one, I think for the current short duration, for what's happening now is, I don't know, is it a Santa rally? Because seasonality also plays into the markets. So generally we say Q4 is a Santa rally because Q4 is generally good if you look at the historical trends, right? 9 times out of, and this is a stat that we also reviewed last week, 9 out of 11 times when the markets fell in Q3, they all rebounded in Q4. So now the folks are looking at maybe Q4 is going to be great. We're going to have a Santa rally. But again, now what we don't know is how the combination of these variables will play out. Will the Q4 rally, will the seasonality of Q4, overcome the expectations of rate hikes or the rate cuts? I don't know. So, and that's a dynamism I think we will just witness as and when things happen in the market. Also, now we live in a different times. So all the history that we have seen over the last 40, 50 years, the times were different because the funds rate were, we had a rate cuts going in, since last 40 years. But now we have the trajectory where the rates have increased. Finally, if you can get average stock returns 8 to 10%, and that's like almost guaranteed with a lesser amount of a risk, why would you want to invest? When I'm saying you, I'm also looking at pension funds. I mean, the bigger drivers of the market, right? You and I, we don't drive the market. We are just recipient of just what market gives, right? We are what we call as a market takers. We will take what market gives. But the so-called smart money, or I would say, I won't call them a smart money because I've seen those smart money blowing up. I will call them the big money, right? The folks with the biggest money pots, the pension funds, institutional investors, you got endowment funds, right? Those are the funds, those big money managers, if they can get 8 to 10% with a decent amount of risk, right? Now the Fed funds rate itself is like 5.5%. The Treasuries, US Treasury is 5.5%. I just had my new Treasury purchase on 5th at 5.56% for, I think, 17 weeks. And you can get the risk-free for 5.5%. And if you go to a little corporate bonds, you can get 7-8% risk-free. Then why would those institutional money would want to invest in the stock market is a big question. There's something called the equity risk premium is not there. You're not get paid to take the risk of the stocks. So these are I think the forces that are driving the markets. I don't know how it will play out. I guess only time will tell, right? We already talked about, okay, other thing, interesting chart that I'll probably just explain the chart. So it goes back almost 50 years, right? When the core inflation rose above the 10-year rates, right? Like if you look here, you have your core inflation rise. Hold on. Okay, yeah. So what this chart indicates is in the blue, you see the 10-year yield, and in the yellowish color, you see the core inflation. What this indicates is when that generally the core inflation, it has peaked over here in September 2022. And it takes almost a year after the core inflation has peaked for the Fed funds rate to peak. So the whole idea behind this chart, going back to 2019 to current, or even looking at 1978 to 1982, the whole idea behind that chart is we are almost at that point of a time, which is the core inflation peaked in September 2022. And now we are almost a year since then. So we have reached the peak of Fed funds rate. Right? Like I said, one of the big drivers in the market is currently our expectations around the Fed funds rate. I mean, and of course the Fed is saying higher for longer, but if we get any indication from Fed governors or chairperson, Chairman Powell, that Fed is gonna cut interest rates or the Fed funds rate, market is gonna just go crazy. They haven't told us. Right now, market is expecting maybe it will happen in June. Probably we will have just one more hike in November, and then it's going to stay steady for maybe a quarter or 4 or 5 months. And then we might see a rate cut coming from Fed. But all those are predictions. And like we have seen, they probably, they could be way off. But that's what market is currently predicting. Okay. So next, I want to look at investor sentiment. And investor sentiment has been a very, I would say, pretty accurate contrarian indicator. When the investor sentiment is at the worst, that's probably has turned out to be the best buying opportunity in the market. And when the investor sentiment is all euphoric, that's the time when you should look at, taking a step back from the market. So looking at AAII members, what do they think for the next 6 months? Majority, I mean, the biggest portion thinks that it's going to be bearish. It's like 41.6% of them. 30% of them thinks it's going to be bullish. Fear and greed index, I think we review this every week. And at the start of the week, it was in extreme fear. So I'm like, oh, maybe we should buy something now. It is still in fear category. And generally, when it is in greed and extreme greed, tend to take a step back, and let market do its thing. And I generally don't go do a big investments when it's in the greed and extreme greed. To me, this serves as a contrarian indicator. What else? I think that's all on the charts, etc. So what did I buy or sell this week? I bought, build a little bit position in India ETF INDA and TTD, which is the trade desk. Didn't sell anything. No sells this week. That's all from my perspective. Any questions so far? Before we jump on to investing process, getting started, I know few of you had asked for this, how to get started, so I thought I'll cover that today. Okay, and then after that we're gonna jump on to Birkenstock pre-IPO. All good? Let me sip some water. And let's talk about investing. Okay, so what are we going to do? So this is probably, this might be a repetition for maybe some of you. I think we covered it maybe earlier this year, but I made some changes to it. But if it is, just duplicate or repetition, my apologies. But it's good to reinforce some of these concepts time and again, I guess. So we're gonna talk. I'm not gonna cover everything today. So from an investing perspective, and I know I went through the same journey of trying to invest in US. Came to US, didn't know how the stuff works here, and when you start to set up your financial life. And when I came here, I already had a family, got a couple of kids, need to send to school, get a house and all that stuff. And I went through my own journey of, starting from scratch in US, and I thought, maybe I'll share here. And that's what I've been sharing over these weekends. So before we jumping into investing, I think it is good to go through a checklist of pre-investing, right? Are you even ready to invest? That's the first thing we need to look at. So we'll go through some pre-investing checklist. Next, we identify goals. What are you investing for? Right? What's your ultimate idea? Why you are investing? When do you want to enjoy the fruits of that? Third, which is I believe is a very important, is know thyself. We as an investor spend a lot of time in understanding the company, in understanding the financials, in understanding the markets and understanding the macro, in understanding the micro, but we don't spend time in understanding ourselves, which is what I think over time I've realized is way more important than trying to understand and pick a great stock. You could pick the next Tesla, right? Sam was earlier saying, hey, if I could have picked up Tesla at $10, whatever number in 2011, great. But if your behavior and your risk profile, if you don't know yourself, you probably wouldn't have held it, the stock, to enjoy the gains. And I know I've been guilty of the same thing, right? You buy a stock, in 2 months, it's double. You're like, dude, or forget about 2 months. You know, in a week, it goes up 10%, 20%. First thing comes in mind, oh, let's take the gains. And that happens many times. Conversely, say you actually bought Tesla, or actually you bought Apple, right? Very cheap. And Apple has fallen down 50% many times in its history. Maybe first time it falls down 50%, you're like, dude, I can't weather this volatility. I'm out. So understanding your risk profile is way more important than understanding or finding next Tesla, finding next Apple. Because even if you find it, you won't be there to enjoy the gains. Then I'll look into the portfolio construction. You could be two types of investors, could be passive investors, and especially in the US capital market, there are so many opportunities to just stay as a passive investor because, hey, I don't have a time to look at the individual stocks or the market. I just want to be passive. Great. There are many instruments. We look at that. The next is on the, if you are active, then how to construct, or at least not how to construct, but at least my thoughts on how I would frame my portfolio. Then look at, okay, now I'm going to talk about that. I'm interested in individual stock. How do I pick the stock, right? What's the process that we go through on picking the stock, right? You go through the dating process, meet a lot of stocks. You have a checklist or, you know, some thoughts on what you're looking for. Then you eventually buy the stock, you marry the stock, right? What do you do? Then, you know, what you will do during that marriage period. And then finally, when you should divorce the stock, what are the reasons when you may want to divorce the stock, right? So today, I think I'm going to only cover till the passive construction. And for some other session, we'll talk about if you want to be active, means if you want to get into individual stocks, then what we should look at, how we should prepare ourselves to buy individual stocks. Okay, anything else you have in your mind? I know there are a few new investors. So if you have any questions, you know, just put it in the chat. Okay. All right. So let's pre-investing checklists. And again, this is just me. And if you have a difference of opinion, happy to talk about it. For me, first thing is make sure that you don't have any other liabilities, right? Especially retire all the other loans. It makes no sense in holding a credit card loan, which will charge you 20% on an average. I think 20% is lower. I think this year they have increased to 22 to 26%. And on the other hand, you're fishing for how do I invest in the stock market, which on an average returns 8 to 12%, right? So that's just math, just doesn't make sense. So if you have any credit card loans or any other form of personal loans, car loans, you might have taken a loan to, you know, for a vacation, make sure you retire all those loans. Those are not really worth it. Right? Number two, make sure you have an emergency fund available, which you can tap into very easily. And emergency fund cannot be in the stock market. Right? My preferred way of emergency fund is CDs. And I know CDs don't even beat inflation. But still, I have almost 8 months of expenses sitting in CDs. Because that's for emergency. I'm not looking to benefit from that. That's in case hell breaks loose. We have 8 months of survival, right? That's my survival kit. You could pick up whatever number is useful, works out for you. Some people talk about 3 months. Maybe if you are an AI engineer, 3 months is good enough for you because there's so much demand of generative AI engineers. Or rather, I would say, if you are working in a service industry, if you are a retail cashier, or if you are a server, there's a lot of demand for those people. But on the other hand, if you are in a work wherein finding a new job is a little difficult, you might want to increase from maybe keep it till 6 months, etc. Right? So make sure this is to ensure that if your regular source of income is lost, you have somebody to survive for next 6 months to 12 months. Right? At least after these, now I would say you are financially ready to talk about investments or about the stocks. Until then, the financial profile itself is not ready. And this personal finance side is very important. And let me tell you one thing. During the bull runs, nobody thinks that it is important. You start to realize the importance of this if it's in a bearish phase, or when the markets are not performing, because then you hit an emergency, and what you got to do? Because you don't have emergency fund, you got to go to your brokerage account and you have to sell your Apple or whatever stocks you hold at the worst possible time, when the market is down. When in the bear market, you should be actually buying the stock. But if your personal finance side of the house, which is your loans, your emergency funds, your insurance, sorry, I forgot to mention here insurance. Make sure you have your life insurance all done before it, right? If that is not done, then investing in stock market won't carry you for long. So that's first part. I say a couple of questions. First, Jay has a comment. What if they can YOLO that credit card to make 1,000%? Yeah, I mean, YOLO worked in 2020 and 2020 and 21. Doesn't work anymore, right? Yeah, you can always go and buy the lottery tickets, but I actually don't want to depend on lottery tickets for my retirement. I know you're kidding. So Shale says, regarding car loan, instead of doing upfront payment, let's continue the EMI, invest money. Isn't a good idea. There are two thoughts around this. One is, how much are you paying for a car loan? So again, I'm of opinion that sooner you retire your car loan, or better it is. But if it is not exorbitant, let's say if you're paying 6% and you want to continue with your EMI, yeah, won't be 100% mad on you. But if you're paying 9% and you're investing in a stock market, which on an average could give you, 8 to 12 with the amount of a risk, right? So what you're getting in a stock market is not guaranteed, but what you have to pay 9% or whatever you're paying is guaranteed. So don't always compare the number to number, also compare the probabilities. Here you have a 100% probability that you have to pay 9%. I'm assuming 9% is a car loan, because I guess that's where it could be, because treasuries are giving you, if 6%, then they'll charge 2 to 3% higher for a car loan. If you have to, here you have to 100% probability that you have to pay 9%. And here you have, for a year, you have 50-50 probability that stock market is going to make money this year. In that case, it's an easy math. I'll retire my car loan. If the car loan is at 4%, 2%, probably I'll keep it. Jay says, if you have a car that isn't cheaper than T-bills, I'll keep the cheap money. Some people have 2.9 loans. Yes, but you have to be disciplined. If you have a car loan that is at 3%, make sure that money that you could have used for the car, you put in T-bills, and don't YOLO with that money. So Jay, I agree with you, but what I have seen is the lack of discipline is you keep that money saying that, oh, you know what, I can get 5% in T-bills, and then you instead go and invest in the next hot stock. So as long as you're disciplined on keeping it in T-bills, I'm with you. I mean, I shared earlier, right? Every year I used to prepay a principal amount on my house. But since last year, the T-bills is paying more than my mortgage rate. And I'm saying, now if I stay disciplined, doesn't make sense. So I stopped making early payments or paying my principal early because I'm stashing all that in T-bills now. But if instead of a T-bills, if I would rather, put that in a stock, then I'm not doing justice to myself. So yeah, if you have a 2.9% loan, no need to pay off right now. If you have any loan which is less than, let's say, 4%, right? Use that money and put it in T-bills. Right? It will be financially foolish to pay that loan. But if it helps you to sleep better at night, I know some people will still say, I don't want to have a loan on my head. That's fine. We don't always, investment and personal finance is more personal than finance. So if it helps you to sleep well, thinking you don't have a loan on your head, fine. But yeah, if I won't pay any loan which is charging me 4%, I would rather stash that in the T-bill, make 5%, 5.5% in that, and then, pay my monthly, whatever, 4% over there. I won't retire that loan. All right, so now, assuming all that is done, now let's talk about investing. Number one, what's your goal if you want to invest? How far do you want to go? Are you investing for retirement? I mean, are you investing for next 20 years? Or you're looking something that will give you need money for next 1 year? Are you investing for a house down payment, which will be due in next 4 months? Or maybe next 1 year because, hey, I want to buy a house in 2024 and I want to start saving for my down payment. Is that the goal? So, and it is perfectly okay to have a different buckets. Hey, I want to save for retirement, which is like 20 years, 30 years down the line. Okay? And I do have to buy a house. Do you have a kids that you want to, save for? Because you want to send your kids to college. You want to save them for college, and that may be like 6 years down the line, 10 years down the line. So more important here is the time frame. Identify the time frame on which you want to make this investment work for. The reason is, depending on the time frame, you have to pick your investment vehicles accordingly. So before my daughter left for college, we were just having discussion around, this investment and all that. And I came up with an analogy, maybe it makes sense. So to you, so I'll share that. Hopefully it will instill that idea of why the time frame is important. Right? So the question, if I were to go to, one block, and if I don't go there, reach there in time, hell's gonna break loose. So I have to go there. If I have to just go for one block, what's the vehicle I'm gonna pick? I stay in New York City or San Francisco. I would just walk. I'm not gonna take my car out. What if the car breaks down? There is a probability, however less it could be. What if I end up in a traffic? Maybe if I have to go 2 blocks, I'll just walk. Not the fastest, but I have the 100% guarantee that I'll reach there in time. I need to be there in the next 10 minutes. I'll walk. What if I have to go 10 blocks in next 30 minutes? What my time frame? I have to go 10 blocks. Maybe I'll take my bike. Because I take my car, good for 2 blocks, and then there's a huge traffic jam after that. And gosh, I'll be delayed. Let's say I have, there's a medical procedure I have to go through. Or I have to be there for someone else's medical procedure. So in that case, maybe I'll take my bike. I know it is a little more work to drive pedal the bike for 10 blocks, but that might be a best vehicle for me. But if I have to go from here to San Diego or LA, what would I take? Hell, I'll take car, right? I don't care. I go out of my house and, 5 miles later, there's a huge traffic jam. I'm not gonna ditch my car and then take a bike. And say, oh gosh, there's a jam for the next 5 miles. I'm gonna get out of my car, take a bike, and then, bike to LA. We're not gonna do that. We all know, inherently, we're not gonna make those decisions. So similarly, when you're looking for investment, understand how long you have to go for, and then choose your vehicle accordingly. Right? If you are going for your retirement, which is 20 years, 3 years, 20 years, 30 years down the line, that's like driving to LA or going to LA or going to San Diego. Right? You don't really care whether you encounter a traffic jam after driving for 30 minutes, right? So that traffic jam is the bear market. Traffic jams are the stuff that we see happened in September, right? September is a red month. Historically, September is a red month. Even this year, 2023, September, we were down, 4.5%. But if your target is to go to LA, San Diego, you shouldn't be worried about it, saying, hey, now I'm hitting a traffic jam for next 5 miles. Who cares? Right? You got a long to go. You're not gonna say, oh, you know what? I'm gonna sell all these things off, get onto or move everything into safer instruments, which is like bike means maybe I'll take bonds. So I consider walking as a CDs, which is riskless. You have a 100% guarantee, no accidents, you will reach your destination. That's like CD, it's like walking. Then when I talk about your biking, that could be more of high yield bonds or dividend paying stocks. You have a higher probability to go there in time, right? With less risk. And when you're talking about riding in a car, I'm talking about stocks, market, take SPY or a broad market, a good core, market cap blue chip stocks. Not depending on where you want to go, you have to pick your instrument. Right? Now let's look at retirement, right? You could save through your 401k, IRA. If you have a company match, always put 100% into 401k or IRA, except unless you are saving for, let's say you have a house down payment coming up. Even then also, you can take a loan against your 401k or IRA. So make sure you maximize your investments in your retirement fund. And especially if your company is giving a match, then not investing in your 401k IRA is like saying no to free money. Who does that? You should never say no to free money, right? Next, if you're saving for house down payment, and I don't know what's your plan for your buying a house would be, but if you are saying, I want to buy a house in next 1 year, right? Then that's like going 5 blocks out. Right? I don't want to invest in stock because I don't know, maybe next 1 year, Maybe we have a bear market. Then I will keep it in a safe place, right? Maybe I'll just walk 5 blocks. I know it grows slowly. There is not much of fun in there, but gosh, I need this money for buying a house for my family. It's a must-have thing for me. Then I'll just walk, right? I'll put in a CD, put in a treasury bonds. And today, CDs are paying you 5%, right? Sending kids to college. If your kid is going to college next year, I mean, I don't want to put money in stock and say, sorry, kiddo, you're not going to college now. Come on, let's go to community college. Let's get you free, right? You're not going to go to a state university, right? Or wherever he or she wants to go. You don't want to do that. But if a kid is going to college 5 years down the line, 10 years down the line, yeah, go ahead, you can pick some stocks. And my preferred way is to go through 5 to 9K plan, because all the growth you get is tax-free. And of course, I think I only looked at California 5 to 9K, but you could pick up any 5 to 9K plan if you want to save for kids going to college. And there are some wonderful 5 to 9K. Some will allow you to manage investments on your own. Some will manage the investments for you. Just tell them, my kid is of this age right now. And just like the targeted retirement works, similarly, targeted college funds also works the same way, right? If you want to buy a new car or go on for a vacation in next 2-3 months, none of these are candidates for stock if your time frame is less. If a time frame is less than, my rule of thumb is, if the time frame is less than 3 years, don't invest in stocks. If the time frame is more than 3 years, right, then let's talk about, hey, which stock should I pick? Again, you could, depending on your risk profile, you could change this, but that's my rule of thumb. Then you want to understand yourself. Okay, Abhi asked question, thoughts on housing prices correction in Bay Area with crazy interest rates. I'm not a good, I'm not a, don't follow real estate very closely, Abhishek, but real interest rates are high, but the housing supply is also not there. So I don't think we will see a huge amount of a fall on the residential housing prices. I mean, the prices have already come down. On an average, the prices across the Bay Area are down 10-15%. But if you're looking for housing in a good school district, I don't think they're gonna get into deep discount, because we don't have a supply. And of course, the demand is always there because of the school district. Commercial real estate, bad. But I guess you're asking for residential housing prices. So yeah, the affordability has come down, but then we don't have our houses also. All right, next one I'll talk about is, do you know yourself? Forget about you trying to learn about the markets. Way more important, do you know yourself? Do you lose sleep if the market is down 10%? How do you feel inside your gut? Does your stomach churn? Do you get up and worry about your investments? And I'll say again and again, no investment is worth losing sleep. Yes. No investment, I don't care whether it is Tesla, whether it is Apple. No investment is worth losing sleep. So you have to understand yourself. What's your risk profile? Okay. Are you a high risk taker? Stocks are great. You could go into alternative assets, cryptos. Are you a medium risk taker? Right? Still have a stocks with, I mean, when I say stock, I mean, you can find a stock at the whole risk spectrum, right? You could have a very high risk stocks, you could have very stable stocks. So I guess stocks figure out everywhere. Maybe you just pick dividend plays. There are bonds, right? And if a very low risk taker means you want a guarantee of principal, then stick to treasuries, bonds, CDs. Again, we have seen bonds lose value, but you eventually, if you hold it till maturity, you'll get everything back. So you have to time your bond purchases accordingly, but you don't lose money if you hold the bond till maturity. And if you say, guys, I want a guarantee. And one thing in life is sure, wherever you have a guarantee, you have a suboptimal performance. So you want a guarantee of your principal, CDs, then or pick treasuries or the bonds. And generally, I would see the risk and the time frame goes in tandem, right? For the short term, you may be risk averse because, guys, I need to save for my kids' college and I want to have it in very safe investments. It's coming up in next 1 year. If I have to save for my kids' college, which is like 10 years down the line, I'll maybe a little more risk. I'll be okay with a little more risk. So generally, I've seen the risk and the time frame goes hand in hand, but some aspect of risk, which is your own emotional behavior, that you have to tell, you have to find out how you feel about losing, let's say, principal. And then you think, should you go in the stocks or maybe plain treasuries, plain bonds? If you have a very high risk taker, because I have a inheritance, a few $1 million inheritance came up, which I wasn't expecting. I had a lot of money. I'm a user risk taker. Yeah, you can go and buy, crypto. You can go and buy some other alternative assets, right? Or you can buy YOLO stocks, like Jay was saying, right? You could YOLO into some stocks. So, but this is a lot more, way more important than, the financial community actually gives the credits to. Now, if you've understood your risk profile, your personal finance side of the house is all set, because these two forms the foundation. If your foundation, you don't understand the foundation, then anything that you build on the foundation will be shaky, right? If you are a risk averse person, and maybe you bought a stock, maybe you bought Tesla at 10, or maybe you bought Apple way earlier, and you were risk averse. When Apple fell down 50%, you would have sold that Apple, and wouldn't have been able to enjoy the multiple bagger that Apple has turned out to be. So it's very important to understand your risk profile, and then pick your build your house on that foundation accordingly. Or I would say build your floors on that foundation. So now we are ready to build our portfolio house. One way is I want to be passive. Passive means I don't want to go and do research on my own, and I'm okay with making market returns. I don't need to beat the market. I'm happy with what I'm, if I can get a market returns. You have a hands-off approach. There are ways you can invest in mutual funds, which nowadays hasn't been a preferred way, or ETF. And of course, when it comes to retirement plans, you don't have many choices anyway. In the retirement plans, I've seen, target-dated retirement plans. Plans are available. If your employer retirement plans have any kind of funds which mimic the markets, SPY, etc., we'll talk about it. But these are the hands-off approach in which you are not picking the investments. You're picking, maybe a broad market and buying everything along with it. So mutual funds have been around for 100 years. historically, mutual funds were all actively managed, means you'll have a mutual fund manager who will pick up the stocks for you. Then the manager will charge, of course, for his time, his or her time and effort. And mutual funds generally have a higher cost of operation. Right? If you want to go for a mutual funds, go with the Vanguard. Vanguard funds are the, I would say, the industry best. These are the lowest cost. So whether it's a fund, mutual fund, or an ETF, always look for expense ratio. So the term, before you buy, you should look for expense ratio if you're trying to compare two funds. If Vanguard has got a fund which invests in a S&P 500, Fidelity has a fund which invests in S&P 500, there's an ETF which invests in S&P 500. You look at all three and see which has got the least expense ratio, smallest expense ratio, pick that up. There's no rocket science in it. Yeah, if you want to invest in funds, Vanguard is the best. ETFs are a little new to the space. The first one was launched in 1993, and this was a S&P 500. We all know by SPY. These are passively managed. These ETFs generally, there are actively managed ETFs also, but many ETFs are generally passively managed. Why? Because the data has shown that the passively managed funds have outperformed the actively managed funds, because there is no portfolio manager who's actively picking stocks, right, for you. So you don't have to pay for that charge. And in the long term, not in the 1 year, 2 year, over a long term, 10 year, 20-year period, the charge that we pay makes a whole difference in the performance. So ever since over the last 20, 30 years, the passively managed ETFs have become rage in the industry. Right? All that we would talk about, QQQ, SPY, IWM, all these are passively managed ETFs. So say 80% of all managed US stock mutual funds underperform. Even they underperform their index that they're trying to mimic. Then why will I not just buy the index, right? So if you want to go with the active manager, make sure they have at least 10 years of market beating performance before you pick up an active fund manager. Okay. All right. ETFs. There are, I think, 3,000 ETFs, close to 3,000 ETFs exist in the market. There is one for everyone. Like I want to say, it doesn't matter what kind of investor you are. If you're a bond investor, you'll find a bond ETF for your liking. You want to invest in 20-year plus bonds, you have an ETF for it. You want to invest in 1 to 3 year, you'll have an ETF for it. Oh, I'm a high growth risk taker investor, you'll have a YOLO ETF for it. There's actually an ETF called YOLO, but that's on cannabis side, right? So there is ETF for every kind of investment that you want to do. Now the bigger ones, and if you're a new investor, you shouldn't try to pick up, a particular industry sector unless you understand it, right? We are a passive ones. I want to pick up, let's say, broad stock, US, top 500 companies of US, right? Things change. The top 10 companies of US today and the top 10 companies in the market cap in the US 20 years ago are different. 20 years ago, we didn't have iPhone, we didn't have iPads, we didn't have AI, we didn't have Quest, right? Things have changed. And if you don't want to keep track of what's on the top, maybe just buy S&P 500, which picks up top 500 companies. And this is one of I would say, most favored way of passive investment is just buy S&P 500. Now, if you want a little more tech oriented, and technology stocks are a little more volatile, but they have outperformed because of look at the earning profiles of the tech companies. it's a lower cost, high margin business, and hence the technology stocks over long term have done better than the, let's say, the capital intensive companies like steel industry. If you're picking S&P 500, you get everything. Now, if you want to focus on the technology stocks, you got a QQQ, which is NASDAQ 100 stocks, right? So one thing is QQQ is the most famous because it picks up the stocks that are traded on NASDAQ, which is generally considered as a tech stock exchange. But if you really want to, but there are some companies that are tech companies but don't trade on NASDAQ. They are not part of QQQ. But I don't want to get into those details. There are other vehicles to invest in. But for someone who's a passive, QQQ is a good enough vehicle to invest for if you are invest in the technology companies. IWM, which talks about small and medium businesses, because here is a viewpoint. You might have a viewpoint saying, hey, 500 is already grown, right? I want to invest some portion of my portfolio in companies that will become apples of tomorrow, right? That could grow to become Google 20 years down the line. But today, they are all small and medium businesses. They're not grown yet. And you want to take exposure to those segments, then you could pick IWM. IWM is a Russell 2000 index ETF. It means while SPY has got top 500 companies, IWM has got 2,000 companies in it. So like many of the banks, many financial sectors, they are a part of those. GLD, we talked about earlier, is a gold. And there are ETFs for silver. SLV is there. SILV is there. I think I had posted somewhere mentioning a few more. You want to go outside US, let's say, dude, I don't know if US gonna be the biggest economy in the world. Today it is. 20 years down the line may not be. Maybe the emerging markets of the world are become the developed countries, and that's where much of the growth may be coming from. Then if you want to invest in emerging markets, there's the ETF for it. You want to invest in developed countries except US, there's an ETF for it, right? VEA. You want to invest in the stock market except US, you got a Vanguard VXUS in it. So where you want to invest, there's an ETF available. You just have to search for it. There are thousands of ETFs available. Right? Here's some list of the few which I use frequently are sector specific. Yeah. Maybe you are you work in an industry, in let's say financial industry, you understand that industry deeply, and you think you have an edge in that industry, and then you want to pick up, put more investment in that particular industry. So there are industry specific ETFs, right? This is the communication services, which includes your Meta and things like that. Consumer discretionary, Teslas of the world. You have energy, right? If you're an energy person, XLE is there. If you have a healthcare, you work in healthcare industry, XLV is there. So depending on if you want to go or increase your exposure to one specific sector, there's the ETF for it. So at the end of the day, pay attention to expense ratio, not ration. Lower the cost, better will be the result. Okay. And more exotic the ETF. And ETF issuers will create ETF if there is a demand, if someone is willing to buy it. Right? Because they got a free money coming in, they'll passively track the index or create a bunch of thematic-based. I've seen thematic-based ETFs, but what I realized, more exotic the ETFs are, more specific the ETFs are, higher the expense ratio, higher is the risk. So if you're okay with the risk, go ahead with it. Otherwise, you got to market ETFs. SPY itself is good enough. Example, ARK ETFs, which is Cathy Wood's ETFs, their expense ratios in some cases are like 0.75, like 75 basis points, pretty expensive. ARKW is 0.79, 0.65, but more concentrated. If you pick up, let's say, some ETF which is for, let's say, 3D printing ETF, which invest only in the companies that focus on 3D printing, is going to be more expensive. And of course, it's a very niche sector, will have a very risk specific to that sector. That sector doesn't perform, your investment is just not going to perform. For Savadu, in personal finance, also talk about 3-fund portfolio, right? You got a US market, international market, and a bond. The fact that there are thousands of ETFs doesn't mean you have to complicate.
You're very loud. Can you do this
Okay,
loud?
you have to complicate your investment life accordingly. You can keep your investment very simple, something that you understand, something that you can track, by just buying low index ETFs like SPY, which is just a stock. Want to have little bond exposure, by BND, 2, 3, or go outside US, so that you, in case US doesn't remain the next economic superpower 20 years down the line, at least you have exposure outside of US. That's all is good enough. Don't have to chase or run after the next shining star in the market. But then you'll get market returns, right? But then I see many folks, chasing it because, hey, it's exciting. It gives you a sugar rush. It gives you adrenaline rush, right? Better would be, if you want the sugar rush, maybe we should go to casino. Maybe we should go to a racing circuit and not come to the stock market. Stock market should be not for getting excitement. Boring investments, perfectly fine. So, okay, so that's all around. If you are a passive investor, what are the vehicles available to you? If you are a sector specific, there are ETFs. If you are broad, you just want to pick up a broad market, don't want to complicate too much, you got VTI, total market. Now, I deploy a few more criteria on how I want to pick up, because I also actively want to reduce my cost basis by selling options. So I look at if it is optionable or not, how liquid is it or not, so that I can continuously reduce my cost basis. But if you're just buy and hold, don't have to worry about that. Cool. So that's all for today's first part, which is building, passive portfolio. Just make it simple. Maybe later on time we'll talk about the active ones. Any questions so far? Useful? Any difference of opinion? You have any thoughts?
Vivek, can I ask a question?
Sure. Go ahead.
Yeah. So, like I am at present, I'm planning to start my own business, so accumulating funds for that. So I do not want to put that money in the stock market. I might need it in next 1 month, 2 months, 3 months, and any point of time.
Mhm.
So what type of investment do you suggest which is secured, and then, for the short term, I can earn something rather than losing value of money, putting them into the bank account, but do not want to commit for a longer period, and the thing is that I don't even know if I'll need it in 1 month, 2 months, or 3 months.
Sure. So like I said, one is, so you want to save your principal because you need to invest in a business and you need that money, right?
Yeah.
So you have to go into that area where there is guaranteed return of principal. One is CDs. And nowadays, if you go to bankrate.com, they offer good CDs. I mean, probably can get 5%, 6% in CDs also. Where does it say CD rates? Let's look at CD rates. And there are some CDs, I think LI have some CD which are like 11-month no penalty CD, means you could withdraw your funds anytime without penalty. So look for those, some no penalty CDs. So this is the easiest way. Okay. The other is you can also buy treasury bonds.
Yes. Yeah,
But
that's
then the treasuries stuff is you could pick up not the savings one. Where's my bills? Let's look at our auctions, recent auctions. So there are treasuries available for 4-week, 8-week, 17-week. And if you get, they got like 5.4%. This is what I was talking about. I think I have 26-week, not 13, I have 26-week treasury bills, which is 5.58% on 10-5. So you can pick up treasury bills.
okay.
But then you have to create an account here, and then, but this is tied for 4 weeks.
Yeah, so then after 4 weeks, I can withdraw the money right away, right?
So after 4 weeks, the money will get back to your account.
Okay.
Okay. And this 5 to 5, okay, one thing I want to clear is, because someone actually asked, so I want to clarify 5.4 to 1 whatever percent, and this changes based on the Fed funds rate. So this is the recent auction. It could be different one, in the next auction or for the upcoming auction. But this is the annual one, right? So 4 week, you might make
Point something.
very minimal. Yeah. So this is the annualized. This is the annualized return, means the 4 week keep on reinvesting.
Yeah. Okay.
So you have a 4 week, 8 week, 17 week, 52 week, 26 weeks. So that's also very.
But this is a guaranteed return, right? If I take a 4 weeks, I know my annualized return would be 4.52, and I'll get back the money automatically after 4 weeks, and then I can buy it again.
Correct. So the way
Okay.
it works is, let's say you buy this, and on the day when the money gets out, let's say if you want to put 5,000, you will probably, the money that will be deducted from your account will be 4,900 something. And then after 4 weeks, you will see 5,000 coming back into your account.
Awesome.
So that's how it works.
Let me explore this.
Yeah, but if this fails, then I think stock market won't fail, because this is guaranteed by US Treasury. So if Treasury market fails, there's going to be a financial Armageddon in the world. Right? So even banks could fail, but Treasuries, it's a US Treasury. So these are the safest ones. I see another. It's a topic for future session: how to review and read earning reports. Yeah, I can do that. I come and share the earnings many times, so now I can also go through how do we do that. Ram said, can you do a technical analysis in future? Ram, I'm not a big technical analyst or chartist, so that's something outside of my competency. But what I can come and share is few of the indicators that I use to give me an idea of whether it is undersold or oversold. But I'm not a big chartist, so I'm not going to do a justice to that. Supal says Robinhood offers 4.9%. Yeah, FDIC insured up to $2 million. Yeah, so these all are banks. They will offer, say CDs or even nowadays, like banks are offering 4% in online savings. AAII Bank offer 4% and 4% in online savings account. So there are multiple options nowadays. But yeah, stock market, don't put in the stocks if you need money for running your business.
Yeah.
Okay.
Thank you.
All right. Cool. So let's get to Birkenstock, and that also covered a little bit of a question that Ramesh you asked is how do I review it? So let's get into Birkenstock. Anyone customer of Birkenstock product? Not stock is not there, but anyone uses Birkenstock? All right, anyone who have heard of Birkenstock before they filed their F1? No one heard of Birkenstock? Okay, then I have a lot of company because I didn't hear about Birkenstock until they filed for IPO.
Yeah, excuse me. I heard of Birkenstock. Remember? It's a shoe company from the 70s. It's just kind of a hippie type of shoe company. That's why I said it's no Apple. I mean, you just put it on your feet and you walk around. Who cares? Apple, you can have your whole life around the products.
Got it. And yeah, you're right. I think it became in vogue in California during the hippie phase in 1970s. It was like counterculture stuff, and it was actually brought into California by a Californian resident. I looked into a little bit of a history also, right, of this company. So the California resident, forgot the name. She went to Germany. She was like half German, half American. And she went to Germany. She used Birkenstock sandals, very comfortable. I don't find it in India, don't find it in the US. And then she went and told founder and convinced the founder, convinced the CEO of the Birkenstock to start selling in US. And that was the time around 1970s during the counterculture, hippie culture, and that's they brought in California. All right, so let's talk about Birkenstock. Let me bring up my document. Let's close this. Birkenstock. Okay. So I went through yesterday late evening. I went through their SF1. So if it is a US-based companies, so each company that want to list themselves on the stock exchanges through a normal IPO route have to file a document with the SEC. It's called an S1 document. If you're a foreign company, you file a document that's called F1 document. It's a difference in the names, but the content, etc., almost stays the same. So if you really want to invest in any IPO, right, I would highly recommend don't invest unless you've gone through this document. Okay. Again, in some other time, I can cover. I mean, you look through this document in terms of what the things that I focus on. But if you have not looked at S1 or F1, which talks about the company, what they do, their history, what's their business, what's their port, right? This is the open book to know about the company. Right? So before you invest in the company, it's important that you understand the company, right? So you don't have to go through that. I'll bring you the summary of what I found there. Right. So first thing I want to focus on is what's the mission statement. Generally, I love to invest in the companies that have identified a mission because it binds all the employees together. You can all target for a specific goal. I tried to find it on the F1, couldn't find it there. I found it on their website. They don't really have a very specific mission statement. So, right, well, that's okay. This company has been around for almost more than 300 years now. Sorry, almost 250 years. Yeah. So this company was founded in 1774. It's probably one of the oldest companies that still exist. Okay, so in a S1 or F1, I probably will be interchangeably saying S1 because that I'm so used to looking at a US based companies, they file S1. So pardon me for that. Okay, this is a F1 document. So what does the CEO says? Birkenstock has all the essential elements of a super brand, a rich heritage, score built around empower all people to walk as they intended by nature. So essentially, let me just take you to the Birkenstock website first. So they make footwear, essentially the sandals. And it's a high quality and are in 41 locations in 8 countries. 100% manufacturing in Germany. They're only in Germany. And like I said, this is kind of a luxury brand for your footwear. So that's what Birkenstock is. Been there since 1774. Birkenstock is more than a shoe. It's a way of thinking, way of living. I really didn't like it. To me, it gave me vibes of little hyperbole of, we work. So, but that's what the CEO's job is. His job is to pump up the interest in the company. As an investor, we need to find out how much do I want to discount this versus take this into my investment thesis. Okay.
Excuse me, Vivek.
Yeah.
Thank you for talking about WeWork. It's a has-been. It's something from the 80s. I mean, let's see what they could do with money, but it's something that I won't buy 10 shares of.
Yeah, I mean, that's gone bankrupt. All right, coming back to Birkenstock. There are close to 5,000, 6,000 people work on it. And CEO says that there are 2 things that the company won't change. We do not compromise on quality. So I like that. And they're focused on quality, don't want to dilute the brand. It's almost 250-year-old brand built over centuries. And we produce every single footbed and assemble over 95% of our products in Germany. So they don't want to. So obviously making goods in Germany is way more expensive. They could have found a better manufacturer in a low-cost manufacturing places, Vietnam, China, India, but they still manufacture and assemble 95% of their products because they don't want to dilute the brand, don't want to dilute their quality, right? And says this has remained unchanged for more than 120 years is their unique footbed. Footbed is, I think, the portion where your feet touches the sandal. Okay. So what next he talks about it, I'm not going to read everything, but he says, from its humble beginnings, Birkenstock now checks every box. We have a double-digit growth. I'm like, fine. I look at your financials. Based on market scarcity and engineered distribution with proven 10 years financial track record. Okay, little bit of I would say, big words. You can ignore all this. It's a product with purpose, love brands, operational model. Okay, I'm seeing some background noise. If you're not talking, if you could get on mute, please. Thing that piqued my interest was this engineered distribution. So like any of the other companies, in the same space, like of Nike or any other companies, most of them sell via 2 channels. One is you sell through your partners, like Nike sell it through Foot Locker, right? But Nike also has a direct-to-consumer brands. You can walk into the Nike's shops, which are Nike-specific shops, or you can order from Nike.com. So these are the 2 channels which most of the companies use. One is direct. One is, oops, okay, I have to mute. One is the direct-to-consumer, one is through the channels. Now, what Birkenstock has done, what they say is, we are in these 2 channels, we are making sure that our product is not getting flooded in any of these channels, and hence the little bit of a scarcity is maintained. I really don't like it if you have to maintain artificial scarcity, but they're actually paying a lot of emphasis on this engineered distribution. Like I said, nothing special here. Okay, so these are the comments. If you see in these chevron brackets, these are the comments while I was going through it yesterday. I'll wait to see why it wants to go IPO. So then I looked at why they want to go IPO. They've been around for 250 years. What they say, we are the oldest startup on the earth. We are a brand backed by family tradition of a quarter of a millennium with the resilience, timeless relevance, and credibility of multi-generational business. Fine. Tell me why this change. Today, we are crowning this development with an IPO. Now you're talking. A logical step that began with our stepping back of family from operational business. So that was my antennas were up. Okay, something had happened in this company 10 years ago. Looks like the family that has owned this for 200 years, they brought in the outside managers. Right? This took us to the next level through our partnership with L. Catterton. I'm like, what is this L. Catterton? We all have heard about, I mean, not all. So Sam has heard about Birkenstock, but I'm sure Sam hasn't heard about L. Catterton. I'm like, what is this L. Catterton? I go over there, I find out that it's a PE firm, which is your private equity firm. So then I realized that the private equity firm came and took over the controlling stake from the family and have been then running the business. And as generally the way the PE firms operate is they'll take a lot of a debt to buy all the shares. The debt goes onto the company balance sheet, and then they'll cut down the cost, clean up the operations, make sure company financial looks good, and generally 3-4, depending on the sector, it takes them anywhere between 5 to 10 years. They bring it back to public, and that's how then the PE firms sell their stake. So that's a general PE model. So now I understand the moment they brought this L. Catterton, now I understand, okay, now I know where they're coming from. So now I need to keep an eye on how much is the debt. How much did this PE firm loaded this company with the debt on their balance sheet? Right? That is not good for a company. So we'll find out later. So I looked at L. Catterton. So looks like so they sold it majority of the stock to L. Catterton at $4.35 billion in 2021. That's where the PE firm bought the stake in Birkenstock. So now let's look at their product. Like I said, they have a unisex portfolio of food-based products. They have over 700 silhouettes. So these are basically, I call it the models, right? So different designs. They have almost 700 designs. They talked about engineering scarcity again. Here's one image where they talk about, how their footwear is different. I think now it has become a common knowledge that our nature has prepared us for arch, whereas most of the shoes earlier used to be a flatbed. But what they say is Birkenstock footbed is also arched like this, so that your foot is you are supposed to walk the way nature intended you to be. But then I was thinking, now this is a pretty commonplace, right? This is the common knowledge. And in fact, nowadays you get those shoe insoles that you can insert in your shoes to give you this arch support, right? So it wasn't really exciting for me. One thing which was exciting is to see the brand affinity. The customers who actually buy Birkenstock end up owning 3.6 pair on an average of Birkenstocks. So, which means it's just like if I buy, let's say Apple, iPhone, probably I'll buy Apple iPad, maybe I'll buy Apple's watch, maybe I'll buy Apple some next stuff, right? So they do have a brand affinity. Then there's a little bit summary. I'll get into the details later, but so far to me, it'll still look like a niche product. Then a little bit on the numbers, 1.2 billion euro of sales, gross profit margin around 60%, net profit of 187 million euros. So sales of 1.2 billion, net profit of 187 million gives around 15% net profit margin, right? So, and they're seeking a valuation of $9 billion. Net profit 187, $9 billion valuation. Do the math, it's around 50 times earnings, right? We'll talk about it a little later. What's the pricing of their sandals? They come from low $40 to up to $1,000 sandals. But those $1,000 are designed by, as a Christian Dior design. So they do have a tie-ups. Most widely sold models are priced at around $60. So to buy this luxury or to buy this iconic name in the niche segment of footwear, you don't have to pay through your nose. You have $40, $60, you can actually get a sandal of Birkenstock. Product concentration. That little concerning to me, that 70% of the revenue comes from 5 models. So then I was wondering, why the heck you have this 700 separate models if 5 of them are giving you 70% of your overall revenue? Collaboration, they have a collaboration with various designers, and that's where you see this super expensive footwear coming through their collaboration. Historical performance, this is where they brought in a professional manager. They hired a new CEO, Olivier, and then the CEO, and there in 2021, they sold it to the PE firm. So I would say a decent growth in revenue. So CEO has done, I would say, a good job. So prior to 2013 till 2012, it was a family-run business. Right? My great-great-great-grandpa started this like 7 generations above me. In 1774, this company was formed. Then, his next heir being the CEO, next heir. Right? Eventually in 2012 is when they decided that we should bring in the professional managers who's not from the family bloodline, and they got a professional CEO. And since then, it's done, I would say, okay. Considering it's a footwear company, it's not a software company where you will have a growth of 30-40%. So how big is the overall market? So they talk about global footwear market around 440 billion euros. I call it as a BS because I don't think they can service all 440 billion because it's a 440 billion include, my local brands also. But this is not where they are playing in. So I want to look for what's the serviceable addressable market instead of TAM. What's the SAM? There are no numbers around it. So for me, I still consider it as a niche company. Great, you got $1.2 billion. I don't think you can get a sales of $10 billion, right? I don't think you can grow to $10 or $20 billion in this particular company, in this particular business. Right? What's a moat or competitive strength? So this is what they talk about. Moat is purpose-built brand around our legendary footbed and products. So they're talking about innovation in the footbed, category-defining, universally relevant silhouettes, proven innovation strategy. I find it more as a fluff. And then they talk about broad and democratic fan base. Kind of agree. They have customers who want to stick to them, efficient demand creation through the engineered distribution approach. If I were to pick up anything which is actually a competitive strength, I mean, this is all coming from management, right? So you have to discount for the fact that CEO will always blow up all the good things. I would say brand is something which I could stand behind that gives them a moat. Right? So selling model we already talked about. They do two channels. One is regular, your what do you call as a partner channels, and then the other one is a DTC. 35% of sales in 2022 was direct to consumer. Now, the good thing in direct to consumer, I would like to see the DTC growing more and taking a bigger share than partner because the margins are really high. If we're selling through partners, the partners take a cut. So if you're going directly to a consumer, margins are higher. Number two, you control the consumer data. Okay? That is very important. Today, in the world of data and analyzing consumer behavior, if you're going through your partner, if I buy my Nike shoes, say in Foot Locker, then Foot Locker has my data. Foot Locker knows how often do I buy. Foot Locker knows which area code I live in. Foot Locker has my phone number. There's my email address. Nike doesn't have. But if I buy on Nike.com, Nike has all that data, which is way more important for them. Right? So I would more the DTC sales, bigger the margins, better will be the customer service. So I want to see this growing up, but 35%, good enough. Let's look at the numbers. So then we come to the balance sheet. So first thing that struck me when I was looking at a balance sheet, which was, my God, how much of a intangibles is there of the total assets? So they have $3.8 billion of assets, out of which 1.6, 1.8, almost 2.4 or $2.5 billion is intangibles, right? $1.67 billion of goodwill, $1.82 billion of intangible assets, which are outside of goodwill. So I want to talk a little bit more on what this is, but this could be either great or it could be nothing, right? How do you value intangibles? It's always a challenge. And I don't think I've seen any company where I've seen such a big intangible listed in the balance sheet. It could be because this company follows European regulations, IFRS, which again, I'm not an accountant, so I don't know. I could be wrong. That may allow them to mention these intangible assets, but because in the US companies, I haven't seen in the GAAP reporting. Right. Anyway, looking at inventories, not much. Cash and cash equivalents, they got $307 million cash on their balance sheet. So, okay. Next, I wanted to focus on loans because remember, I said earlier, it was a PE company. PE company modus operandi is to take a loan, put it on the company's balance sheet, which shows up here. $1.9 billion of loans. And then they have few more, these are the long-term loans, and then you have a little bit short-term loans of 46 million and other payables. So when the half of your assets are intangibles, it is important to dig a little deeper into what's the source of that intangibles. Like, are you just creating out of thin air? If you have cash assets, that's something which is, you can put a value on. It's 100 million is 100 million. If a plant and equipment, if a land, there is a value you can put to it. In valuing intangibles is always a little shaky, right? So I do want to get into what's the source of intangibles. So I try to find a little more around intangibles and, how much should I discount these assets? And good for me that the guru of the valuation in the world, Professor Damodaran, he actually has run through the intangible valuation of Birkenstock. So I just picked it from him, his slide. It says there are 4 sources of intangibles that he sees it, and he's the guru of valuation in the world. right? So I'll just take it by what he says is his brand name. This we already talked about. This I was aware of. Celebrity customer base, because Birkenstock cuts through generations of different celebrities. And these celebrities, they don't have to sell it to, they don't pay these celebrities for actually endorsing Birkenstock. They just give them the shoes, and the celebrities are very happy to wear these because these are like a high grade, good quality shoes. And they are happy to talk about and flaunt it. It's a good management that I understand. We look at the revenue growth of the company that I can get behind it. And final, the looks like in the movie Barbie, Margot Robbie, she wore a pink Birkenstock sandal. So this could be a short-term, intangible a bump to the sales, not a long-term, but from a long-term perspective, these are the three big intangibles as Professor Damodaran looks at it, right? And then he has done whole analysis of how much value does each of these intangibles could be adding to the overall valuation of the company. So then I looked at the P&L statement. Right? So balance. So earlier, before I could find this information, I was a little concerned around how to value these intangibles. But now I'm not that concerned. It's not completely, out of the roof. So then let's look at a P&L statement. Nothing much to talk about here. 101.2 billion sales, 187 million net profit, right? Gross profit margin of close to 60%, and net profit margin 15%. Now, for us we're reviewing a lot more of, looking at Apples and the Googles of the world. Look, net profit margin 15%, that doesn't sound exciting. Why would want to invest in such a low margin business? But then if you look at the industry comparison, I don't have a comparison for net margin, but a gross profit margin, 60% is what the industry standard is. So I'm like, okay, that's not really bad. From a luxury brand industry standard perspective, 60% gross margin is the norm. Now, if you're coming from evaluating the SaaS companies, wherein we see software companies, where we are looking at a gross margins of 80%, 90%, certainly 60% seems very low. So it is always good to compare apples, to do an apple-to-apple comparison, go to the same industry and see what the similar kind of a profiles are doing. What's the business profile of the similar company? Right? So looking at them, 60% is okay. Right. Third is the cash flow statement. Where's the money going in, going out? Because net profit is an accounting profit, not really the money in the bank. Cash is what the money which goes in the bank. So we're looking at a cash flow, nothing that caused me concern. One good thing that I found here, no stock-based compensation. After looking at hundreds of technical company balance sheet or cash flow statements over the years, I'm so attuned to, first of all, go to cash flow and look at where's the SBC? Where's the stock-based compensation? And is the company hiding or artificially jacking up their free cash flow by putting a lot into stock-based compensation? I didn't see any stock-based compensation here, so which is good. So they have what, 234 minus 70, they have close to 150 million free cash flow, and they pay interest of $70 million per year. Right? So currently they have a cash, $235 million cash on their balance sheet, which is fine. 25% of their, so this is 230 million, 34 million is the net cash that they generate. Now, because they have plants, they also need to spend for the upkeep of the plants to keep the business going. they spent almost 25% of it, right? $70 million to just keep the business running in the maintenance, etc. And another close to $70 million in paying the interest payments, right? Which is okay. I mean, doing these things, they still have half of their cash available. So nothing concerning here. And believe me, those who've been around, we've found a lot of concerning stuff in these free cash flow statements, but Birkenstock looks clean. Now look at the debt on the company, because it came from a PE. So I tried to search for the debt. I do find the company had to, basically PE firm took on these debts on the company. So my intuition was correct. Looking at the strengths and the moat, like I said, brand is the one thing which I find is a strength of them. Management, I believe that the new management is doing a good job. Competition is, it's not a, everyone can make shoes, just that they are doing it in a much better way and have a big long history of making really comfortable shoes. But anyone who can make shoes can be a competition here. Finally, things that as an investor, you should find out. There is nothing, I would say, unsavory that I could find about management. Other thing you want to look for, what do you want to do with your IPO? I'm giving you money as an investor. What are you going to do with that? So the principal purpose is to basically repay the loans. So what I found is they say they intend to use to repay the borrowings that are outstanding. Right? So all that is fluff. The real stuff comes here. So it is not to buy. So there's all this money that they're raising is not going to into company businesses to increase, let's say, sales or to set up a new plant. Majority of it will be just to repay the loan, which I'm in two minds here. In a way, it is good because if you're repaying your loan, your capital structure of the company becomes better. You have a less debt, you have a less interest payments going forward. But would you rather not use that money to grow your business, to maybe increase your sales from 1.2 billion to maybe 2 billion, 3 billion? Maybe there's not much of an opportunity. I don't know. So that's something which I want to keep an eye on, is that instead of growing the business, you want to use it for just repaying the loan. From a capital structure point of view, it is good. But then if I'm a type of investor who want to see the company growing, then that's a negative. Anything on financial controls, nothing bad I saw. So now so these are the things that, there was a question, right? How to read earnings statement. A little bit I covered by, when I look at the earnings of a company, I go through all their financial documents. But this is how I will look into and analyze a company for an IPO, right? Their business, their strength, overall market, should be a big market. What's their moat? Because if they don't have any moat, anyone can come and disrupt them. How good is the management? How much management has skin in the game? In this one, they don't have much stocks. So they don't have a huge skin in the game for the stocks to become, from a stock perspective. They all are getting paid in cash. Okay, so now let's talk about IPO. Valuation. They are seeking $9.2 billion worth of valuation, right? Which means, and I don't remember this is euro or dollar, but I guess dollar and euro are almost same right now. Or how much is the exchange rate? I think pretty much similar. So it could be a few $100 million up or down, doesn't matter. So, but this PE firm bought it around 4.5. They are seeking 9.2, which is 100% gains. Price range, Birkenstock is targeting is 44 to 49, in between 44 to 49 billion dollars Total share on offer is 33.26, raising 1.48 billion, and expected to trade on 11. Now, if you looking at the company's business, expected rate of growth in future. So this company has grown 15% year over year for the last 10 years, right? So if you assume that it's continue to grow at the same rate for the next 10 years, and beyond that, if it grows at a normal market growth rate, which will be 3 or 4%, if you go through the whole DCF analysis, discounted cash flow, the intrinsic value of the company comes out to be around $8 billion, right? Give or take. It's actually between, let's say, put it between $7 to $8 billion. So from that perspective, they are seeking $9.2 billion. It is maybe 15-20% higher, 15% higher than what they are worth intrinsically based on their business, etc., but not, egregiously overpriced. So given that they are looking for to price a stock between 44, 49, I would say, still a little bit overpriced, 15% overpriced. And when it comes to IPO, there are two things that we need to keep in mind. IPOs are never valued. It is always priced, which we are seeing here. If we go through the value of the company, you get a value of, let's say, $7 billion. But they're pricing the IPO at 9.2. Number two, IPOs are never bought. They're always sold. Company will sell you. So as an investor, you're always at a little disadvantage in investing in IPO. And given the fact that it's a shoe company, not a really high growth business, not really an industry that I understand really well, I'll stay out of this. But let's say if the stock listed, they eventually go at 46, 47, middle of this range, and the stock falls down to 30, I'll probably be interested in looking into the stock, but not at 46. But that's just me as an investor. I would, this sector as well as the growth, as well as the current valuation, they're all not in favor of me. So if I go to invest in a shoe company, I really want to see a bargain, which I don't see it here. But that's all on the, what else? Yeah, I think we already talked about it. Now, for now, I'll stay away from it. They're looking at PE or 50, which from luxury brand perspective, not that expensive, but I think there are better opportunities for my money than in this company. I think there are better companies I can find which have a higher growth, better return on capital, and are cheaper, but not in the shoe stock. Maybe a little more risky, but I think I'll put my money over there. But you have to know thyself. You have to see what kind of investor you are, and then see if you want to take a position in this. All right, so that completes our analysis of a pre-IPO of Birkenstock, the shoe company, the footwear company, the luxury. Can I call it an Apple of footwear? I don't know. Maybe. Let's say the Apple of footwear. All right, any questions? We're done for today's session. Guys, sorry we ran 9 minutes over, but that's nothing unusual. Every session we go a little bit over. Any questions on Birkenstock? Or I haven't even gone through the other stuff that I wanted to talk about, but I think we are over time, so I'll skip all this. Any other questions? All good? Useful? Again, we meet here every Saturday. My intent is that you get benefit from these 2 hours that you spend here. So do let me know what are the topics that interest you so that it's useful. At the end of the day, I mean, if you go back saying, gosh, I didn't learn anything new, then I think that's my failure as a teacher. So, and I don't want to fail. So do let me know what else you want to talk about. Cool. All right, looks like no question. I'll let you guys go. Thank you very much. Do you have a WhatsApp, Telegram? I actually have a Slack group. So Sushil, if hold on, I'll give you the Slack group. So this is I don't know. Sometimes I think, should I go on Telegram or Discord? But I don't have too many things to talk about on day-to-day basis, right? Because hey, what happens in a market in a day? Who cares? But I do have we are on this Slack. Sometimes there's a little bit activity on Slack, so we do. If you have a questions, so I can send you the link to the Slack group if anyone wants to join. I think I listed it on Meetup also. Let me just check. Or you can, I think, isn't it listed on the Meetup? No? Okay, I'll have to see where did I list it. Anyway, oh, I don't have it on, maybe I removed it somewhere, I don't know. So I will send you the link for the Slack if you want to join, and if you have any question between the week, yeah, feel free to ping me on Slack. Or the other way, which I've become more active, as I told you in June, is Twitter, right? And I've become more active on Twitter nowadays. So she'll ask, is the same Zoom link or is Saturday? Get a new Zoom link. Always pick up the Zoom link from the meetup, because sometimes these meetings expire, and I know the recent one, and I don't know if it is going to expire next week or a week after that. So I would prefer you always come and pick up the link from the meetup, because the meetup I'll always get, and if I cancel it, I'll cancel it on the meetup. It becomes much easier for me to coordinate through the meetup. Yeah. Are the ETFs on crypto? Ramesh says, please cover guidelines of PE ratio, return, etc. So I do want to, and I think I spoke about it some time ago. I do want to talk about, I just need time to prepare for it, is 14 guidelines that Warren Buffett used for stock picking, right? You may not use all 14, but that does go through what's your gross margin should be, what's your return on invested capital should be, how much should be a debt to equity ratio. So I have to prepare a content for it. I think I have it very rough form. So I will cover that. So I think that's what you're looking for, is if you want to really pick up some individuals. If now we're talking about, hey, I want to pick up individual stocks. So how should I look for that? Yeah, so I'll cover that. Give me some time.
Vivek.
Yeah.
Yeah. I want to know, suppose you come to know of a stock from some random person, random website, anywhere in the world, and then what should be the first source of researching? We can go to the website of that stock, look at the company, look at the financials, but what is the first? On Google, there is information all over the place.
Yeah.
So is there any website that you suggest where we can go and look at the financials in a better way, or these ratios in a better way?
So first thing that we should do is to go and look at their latest quarterly result.
Okay. So where should we look at that?
So you can find any of the company, they will always have their results on their website. So you should search for investor relations part of their website. Give me any website.
Yeah, that I know, but those area you have to download each financial statement. You don't really get a comparison of how the company has been growing over the period,
Okay,
because
so
once
then
you
you
are-
okay, I get your point. So the other one you can use. So for me, I mean, I found this as a, let's say, let me pick up one of my favorite stocks, right?
also you do stock, you look at stock analysis. Okay, this is
Yes.
the one you can use it. Okay,
Yeah. So I use this. This has got at least 10 years of financials,
yeah,
and
okay.
it's got a ratios, etc. also over here.
Yeah. This is the one I have been using, but I know I thought maybe you have some other which is probably the better one compared to this.
So I think in the next session, when we'll talk about actively building portfolio, I'll also talk about different tools which are
Mhm.
available for you to go and research about the websites, etc. So hold on your question until then. So
Okay,
today,
thank you so much, Vivek.
okay, no. Are there EFTs on crypto trading now? Oh, I think Pishang, you meant ETFs. So yes, there are ETFs on the cryptos, and they have been there for quite some time, but those are not on the spot crypto. SEC has not approved any ETF on the spot Bitcoin or Ethereum. I think these are the only two cryptos on which the issuers have filed for ETFs. But there are ETFs that are existing on futures, right? On Bitcoin futures, or from this Monday, 8 new ETFs on Ethereum futures started trading on the exchanges. So yes, there's Ethereum. So we do have a Bitcoin as well Ethereum future ETFs on the markets. But if you are really into crypto, futures have got, again, I don't go deep into futures, but it's got a carrying cost. So even if Ethereum has, let's say, is gone up 20%, you will see that your ETF will underperform it because of the carrying cost. Okay. As a retail investor, and if you're okay with opening an account in one of the exchanges, Coinbase, etc., better would be to go and just buy Ethereum directly on an exchange rather than doing a future. Future is not a efficient vehicle to get an exposure to the crypto. It is good for I would say the let's say pension funds, etc., who can't get direct exposure because they have to go and then modify their charter, etc. Right. So that's the case. Okay. All right. All right. Looks like no further questions. So thank you. I'll see you all next Saturday. Hopefully you find this useful. Opisha said, I would like to add one to the IRA account. IRA account, yeah, then you don't have much option. So IRA account, you can only buy the ETF. You not get direct. You can't put your Ethereum into your IRA or your Bitcoin into IRA. The other option is the grayscale trusts, but then those could be trading at a discount or a premium or their net asset value. I mean, we talked about these things in our previous meetings, but yeah, if you're an IRA, then it's an ETF or the trust fund you can buy. Okay, cool. All right,
Sorry.
guys. Yeah, go ahead.
I'm sorry, I missed the beginning. Did you talk about the market?
Oh, yes, we actually already covered a little bit of the macro side of the house. So you can probably go through in the recording.
How do I get the recording?
Is there on my website? Okay, so let me just go there and share with you all.
Excuse me. YouTube.
YouTube, it actually comes a week later.
Well, that's okay. Better late than never.
That's true. Yeah, if you can wait on YouTube, then yeah, you can.
What is your website?
Website is okay. Let me just open that. Website is optiongig.com. If you come and register here, right? If you sign up, it's free. So you'll get basically all the webinar videos will be there. Plus, I've done a boot camps around options, etc. You know, how to get started in options. All that is available on my website.
Okay. Oh, for $20 you give the.
No, $20. No, I'm not doing this anymore.
Okay.
I only have it now free.
Okay. And do you give out trades as well? What you're doing?
I used to share my trades, but I've stopped doing that anymore. I'm focused on something else, building something else.
Okay. Thank you.
Okay. Or the other thing is, like I said, I think, yeah, my channel or whatever. It'll get posted here get to my channel. So yeah, I don't use that much. Yeah. So if you search for Optiongig, you'll see some of my comments here, you know, at least these weekly videos, I do post it. So this one was I think this video will go out maybe by Monday, Tuesday, whenever I find time to go and update the YouTube, I'll do it in the next, a week later. So that's another way to get a recording. Cool. Or are you listing the options you sell in any of the channels? Actually, I started sharing it on my Twitter very recently. So if you follow my Twitter, and again, I just became active on Twitter in June. I'm still trying to figure out how best to engage on Twitter. So for example, I did talk about on 6th what I did. This is my Disney. So yeah, I put it on Twitter. This is for 5th, right? So if you follow me on Twitter, you'll get notified. Cool. Alrighty. All right, guys. Thanks a lot. I'm also tapped out. Gotta make some lunch.
Thank you.
Thank you, everyone. I'll talk to you all next week. Bye-bye.